Hi everyone, welcome to my channel. This is Quantitative Unicorn. If this is your first time tuning into my program, I want to let you know that all the demos and data files in my program are free to download. You can find these files by clicking the link below the video. And if you are a returning viewer, I hope you have taken my advice and spent some time practicing the code we covered in our last episode. And just a kind reminder, this course is meant for educational purpose only. So the data and the information presented in this video is not investment advice, okay? And please subscribe to my channel, like the video, and click the bell icon on to receive the latest updates. Thank you. Today, we are going to explore an additional quantitative tool that can be utilized to validate assertions regarding the population, and that is hypothesis testing. How exciting! Well, let's get started. In many instances, it becomes necessary to demonstrate the validity of assertions. For instance, consider the scenario where you are a venture capitalist and are presented with the graph of the daily close price of Microsoft from 2014 to 2017. Should you invest in this stock? Well, at first glance, the price appears to be in an upward trend, and one may surmise that the average daily return is positive. However, when we plot the daily return directly, we observe a mix of positive and negative returns, making it less obvious to assert that the average daily return is positive. Furthermore, it is unclear if the average daily return is zero or not. Examining the histogram of daily returns, we observe a rough symmetry around zero. However, it is still ambiguous whether the average daily return differs from zero. To make a judgment about the assertion that the average daily return is not zero, we need a quantitative statistical tool, that is hypothesis testing. In statistics, hypothesis testing utilizes sample information to test the validity of conjectures about these parameters. The first step in hypothesis testing is to set up the hypothesis. There are two hypotheses: null hypothesis and alternative hypothesis. The null hypothesis is usually the assertion that we are against, while the alternative hypothesis is the conclusion we accept whenever we reject the null hypothesis. In the example above, the null hypothesis is that the population mean, i.e. the average daily return, is zero. The alternative hypothesis is that the average daily return is not equal to zero. Whether to reject or not to reject the null hypothesis is a sample-based decision. Intuitively, given that the null hypothesis is correct, the difference between the sample statistic denoted by x bar and the population parameter mu cannot be very large. If the difference is significantly large, the null hypothesis should be rejected, and we should accept the alternative hypothesis. To measure the magnitude of the difference, we also need to consider the standard deviation of the sample, because the magnitude of the difference is usually larger for samples with a larger standard deviation. Therefore, standardization is necessary. If we know the population standard deviation, the standardized sample mean is denoted as z hat, and we use the z distribution if the population is normal or if the sample size is large. If z hat is far away from zero, the null hypothesis is not likely to be true. However, in most situations, the population standard deviation is unknown. In such cases, we can replace the population standard deviation with the sample standard deviation, resulting in a new term denoted as t hat, which has a new distribution known as the t-distribution. Similar to the z-distribution, the t-distribution is symmetric with respect to zero and bell-shaped. The distinction lies in the tails. The t-distribution possesses flat tails, which signifies that t has a greater probability of taking on values in the tails. The t-distribution is dependent on the degrees of freedom. In our instance, the degrees of freedom is equal to the degrees of freedom of the sample standard deviation, which is n-1. As the sample size increases, the degrees of freedom also increases, and t becomes more similar to the z-distribution. Thus, with a large sample, we can consider t to be equivalent to the z-distribution. With a large sample, t hat follows the z-distribution. Hence, we denote this statistic using z hat as well to emphasize that it follows the z-distribution. We can calculate z hat using Python. X bar is the sample mean, which is the average daily return. S is the sample standard deviation, and N is the sample size. So Z hat is equal to 1.6141, which is a standardized statistic. We use mu equals to 0 because we assume the null is correct. At the beginning, if Z hat significantly differs from 0, we can conclude that this sample is not drawn from the population with a mean of 0. Consequently, we can reject the null. To find the significance level, we first fix a level of significance, alpha, which is typically 5%. Then we find the rejection regions in the distribution of the test statistic corresponding to that level of significance. For a two-tailed test, the rejection regions correspond to the values of the test statistics to the test statistic that are less than minus 1.96 or greater than 1.96 for alpha equals to 0.05, of course. So if the calculated value of the test statistic falls within the rejection region, we reject the null hypothesis and conclude that the sample provides evidence against the null hypothesis. Well, when conducting hypothesis tests, it's important to note that there is always a chance of making a type 1 error, which is rejecting the null hypothesis when it's actually true. The probability of making a type 1 error is equal to the level of significance, which is alpha, chosen for the test. Therefore, if we choose a smaller alpha value, the probability of making a type 1 error is smaller. To find the critical values for the z-distribution, we can use the norm PPF function in Python, which calculates the inverse of the cumulative distribution function for a given probability. For example, to find the critical values for alpha equals 2.05, we can use the norm PPF function, and this will output rejection region z hat smaller than negative 1.96 or z hat greater than 1.96, which corresponds to the rejection regions for alpha equals to 0.05 in a two-tailed test. So based on the calculated value of the test statistic and the rejection regions, we can make a conclusion about the null hypothesis. If z hat falls within the rejection region, we reject the null hypothesis and conclude that the sample provides evidence against the null hypothesis. Otherwise, we fail to reject the null hypothesis. In this case, since z hat equals to 1.6141 does not fall in the rejection region, we cannot reject the null hypothesis and conclude that the average daily return is equal to 0 at the 5% level of significance. Well, this looks counterintuitive, right? The stock price has increased roughly from $50 to $90, but the mean of the log daily return is 0. Well, actually, the mean daily return being 0 does not mean that the stock price cannot increase. Daily returns refer to the percentage change in stock price from one day to the next. And the average daily return being 0 just means that on average, there's no overall trend in the stock's daily price movement. However, this does not necessarily mean that the stock price will not change over time. The stock price may still fluctuate up and down over a longer period of time, but on average, those fluctuations will balance out to 0 daily return. It is also important to note that the mean daily return is just one statistical measure and should be considered alongside other factors when analyzing a stock's performance. However, as a general principle, venture capitalists and investors often look for stocks that have a positive expected return, as that is what generates profits and returns on investment. A stock with a mean daily return of 0 may not be as attractive to investors as a stock with a positive expected return. But other factors such as market trends, industry growth potential, and company management may also influence investment decisions. Ultimately, it is up to the individual investor to assess the risks and potential returns of any investment opportunity. Okay, back to statistics. So in hypothesis testing, we need to choose the appropriate test based on the specific hypothesis that we want to test. In the case of testing whether the population mean is positive, we need to use a one-tailed test with a null hypothesis that the population mean is less than or equal to 0, and the alternative hypothesis that the population mean is greater than 0. We then calculate the test statistic, which is a z-score in this case, and determine the significance level, which is alpha, and identify the rejection region. So in this case, the rejection region is on the right tail of the z-distribution, and we reject the null hypothesis if the test statistic falls in this region. So by rejecting the null hypothesis at the chosen significance level, we can conclude that there is evidence that the population mean is greater than 0. And this provides additional information beyond simply rejecting the null hypothesis that the population mean is equal to 0. Okay? And a more prevalent method of hypothesis testing involves the computation of the p-value. We recognize that assuming the null hypothesis is correct, the standardized sample mean follows a z-distribution. What is the likelihood of this distribution taking a value more extreme than the observation in our given sample? This probability is known as the p-value, and if it is less than a predetermined threshold, which is alpha, it indicates that the null hypothesis is unlikely to be true. With the p-value approach, we only need to compare it with alpha, even though the method of calculating p may differ. A demonstration of the p-value approach can be observed in the two-tailed test. The function ABS is used to calculate the absolute value, while norm CDF computes the cumulative probability. So in the future videos, we will apply all of the knowledge we have gained so far to explore the relationships among various variables and construct a prediction model for the stock market. Lastly, we will evaluate the performance of our models. All right, that concludes our content for today. I really hope you guys got the hang of it. If you are feeling confused or are frustrated about any of the code we showed in the program, please don't stress. I will go over the ins and outs of every line of code in the next episode. So we will get you up to speed in no time. And if any of the financial theories or statistical concepts we talked about are still a bit of a mystery to you, just drop me a comment. I am more than happy to give you some extra context or examples to help you out. And speaking of comments, I'm always open to your feedback and suggestions. So if you have got any thoughts on how we can make this show even better, please don't be shy about sharing them. And if you haven't already, I would love it if you could subscribe to my channel to stay updated on my latest videos. And if you have friends or family who would also appreciate the knowledge of building stock trading models in Python, please feel free to share my videos with them. I truly appreciate your support, and I'm excited to continue sharing more tutorials with you on my channel. Thank you again for your time, and I look forward to catching you all in the next video. Goodbye.